Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Friday, March 14th, 2025, coming to you from an airport lounge, so hence the slightly odd lighting, and we will keep it short given the desire to get the news out before my flight leaves. But let's share our screen and go from there. It has certainly been an eventful week. So I've termed this a study in perspective, as there obviously has been some quite dramatic market action this week, but I wanted to provide some perspective so that we see just how often these kind of corrections can occur. However, that's not to say that this is business as usual, and we do need to look at some of the circumstances leading to some of these market conditions. As usual, we're going to go through inflation, interest rates, geopolitics, equity markets, and other asset classes. And this week, we're speaking about whether the market correction is indeed a detox, as was suggested by the Secretary of the Treasury. Is this the detox that nobody had really wanted, but some would argue that was needed? We'll also then do that study in perspective I mentioned, and we'll look at what could be maybe a binary outcome, depending on some of how some of the geopolitics is resolved. The binary outcome relates to whether from having a Trump trade, we could then go to having a Putin trade, as was suggested by one commentator this week. Let's start with inflation as usual. We have already had some positive news on the inflation front, inflation inching below 3%, giving positive boost to markets in a week that had a lot of negativity about it. The sense that the services inflation was stubborn but slowly coming into check did give some confidence that prices could come down and that the Fed could remain on their easing trajectory. And this comes against the backdrop of Europeans' inflation also being closer to 2.6% in the latest read, well below pandemic levels, not at the 2% level yet, but heading in the right direction. Again, this is very episodic, sometimes the drivers of inflation, and this suggestion that it was actually air tickets that drove some of this inflation read down, but things like eggs and other groceries are still unusually high in price. However, if we look at the inflation break-evens in the US, we can see that bond markets are now expecting the 1 year and the 2 year to be quite a bit higher. So they are rising and they're certainly above the Fed's 2% target. So as before, the bond market has been quite volatile, has been fretting and perhaps not believing some of the hype of the equity markets. We can see this happening. Again, this is with respect to inflation. We've also seen it with respect to the likely movements of the Fed. Now, when it comes to equity markets, we have had the great unraveling this week. It has certainly not the first week of it. We've seen it started really since Inauguration Day, a persistent weakness in tech stocks coming off of their hype, some concern around the economy. But as we said before, we had a suggestion last week that there was a Trump put in effect. Now, what we're suggesting is that put in effect as strong as we thought it was. And certainly the rhetoric out of President Trump was what drove markets this week, suggesting that there would be a period of necessary pain as he right-sized the economy or said about restructuring the economy as he sees it. And this was a sense that he was not necessarily that mindful of market direction. This was offset by some comments from his cabinet, but it does seem that what the president says counts, as it is very much his policy that is being enacted here. So quite a bit of retrenchment in the S&P, essentially now in correction territory, losing more than 10%. The Magnificent Seven have been deemed by Goldman Sachs as a Maleficent Seven. They certainly have seen their fortunes turn. They have been lagging during the recent drawdown, down even more than the rest of the S&P. They've been down 14% year to date. The S&P down only 1, so dragging the S&P 493 down only 1, dragging the entire S&P down, but the Magnificent Seven very much the lion's share of that. And we can see that if we look across the Magnificent Seven, one big outlier, Tesla. Nvidia hasn't done too well either. We know that its fortunes do drive the rest of the sector, but Tesla down 52% as of this chart. Clearly, it's repeated in this chart. We can see that while all have been declining, Tesla has been an outlier. That could be primarily due to the very high profile actions of Elon Musk. And we know that there has been some governmental response to that, even in terms of encouraging the purchase of Teslas. But equally, definitely a social movement has developed around the tastefulness of owning Teslas, and that is being reflected in the stock. Were there some bright spots? Fascinating here to have a stagflation index from Goldman Sachs. That is a stagflation index that has beaten the market. We can see that that has been in the stagflation index, it's long short, so they are actually short the large tech stocks. They are long the value stocks, and that has been a strong component. So it is possible to have some protection in this market, as this would show. If we were to put some perspective around the drawdown, now that's the important part here, it is that this type of a drawdown is actually a median annual drawdown 10%, and this has been what the S&P has experienced in the last 40 years. We know that it's usual for an index like the S&P to experience a drawdown of around 5% twice in a year, and equally to have a drawdown of 10% on average once every 2 years. Obviously, the median is derived from having very steep drawdowns and less steep ones, but this is all to put it in perspective. So if we're at close to that 10% level now, we're really just at the median. So not to necessarily panic about, and to give some perspective to that number. When we look to across the world and what other indices are doing, we can see that the European value trade has beaten US growth by 37% since Christmas Eve. So a strong reversion to the mean in that sense from European value. And we know that there have been drivers for that. It was overlooked. There had been a dramatic, perhaps, galvanization of European sentiment after the J.D. Vance speech, but definitely a strong recovery there in European stocks. And what I've said here is this a Trump put or is this a pain point? I have the question, anyone, because it seems like we're now stumped and don't really know how to respond to the idea as to whether Trump is motivated by the markets or whether he's more focused on his long-term vision to in-source goods and industrialization within the US again, to reduce these trade deficits, and is willing to tolerate pain. And the question was before, how much pain? Would it be a retrenchment to inauguration day levels? Would it be a 5% to 10% level? And now that we're back to the closing level of November 5th, this had been the question, is this now the level? I think with the latest statement, we do question whether there is in fact a level. We spoke last week about the uncertainty in the markets and VIX and how that has been making 3 higher peaks in the last 24 months. We have seen certainly a spike in volatility in markets, quite a bit of stockholder uncertainty, stockholder souring of sentiment, and that has been repeated across the consumer landscape. And many indices have now been derived. This is the Bloomberg Global Trade Policy Uncertainty Index. Have to admit, this was a new one for me. We can see that has been really at an all-time high. We would have had some uncertainty during Trump 1.0, relatively calm period during the Biden administration, and now post-election of Trump 2.0, spiking uncertainty around trade policy. This is to be expected. We are seeing norms being upended really in an unprecedented way, particularly with our closest trading partners. So no surprise, actually, maybe it's a little surprise that isn't even higher. Economic policy uncertainty has also surged, and we did see again that surging after COVID. But to see the policy uncertainty is surging, we've had the president speak about abolishing the IRS. What would happen to the fiscal flows in that case? We haven't yet seen much detail on the tax cuts that are promised. We know that the Fed is still independent, but we know they could come under pressure. And equally, we've seen a dramatic amount of cuts in some of the agencies, which a lot of focus on the budget deficit talk around that. But this is clearly an index that is starting to show worrying signs of getting higher. Again, there's a podcast I'd like to refer you to here. It's Decision Nerds podcast around certainty. I will do a separate small market happy hour podcast on this concept. It'll be loaded a little bit later, so we'll just return to that. When it comes to Europe, I've already showed the difference between European and US stock markets. When it comes to European junk bond spreads, they have now dipped below the US for the first time in close to 2 years. That has been that is a suggestion that the US is now, again, more uncertainty, perhaps had a stronger bid there, and there was more downside. So the European high yield having a little bit of a rally there. We know that the skirmishes are continuing on the domestic front. We know the government shutdown vote is coming, and the Democrats don't have many good options, so they may have to vote for a plan which leads to a cutback in Social Security. That, of course, would go against their policies and clearly an anti-populist move, but that they may have few options. And then some of the DOGE policies facing backlash in the courts. We spoke last week about unintended consequences. We know that Mark Carney is now the new leader of the Liberal Party in Canada. Their support, the gap with the Conservatives, has essentially closed up, much of it thanks to Trump and his 51st state overtures, as well as his trade policy. So unintended consequences, not only with our northern neighbour, but also with many European solidarity routes. Gold is again the winner of this. It has been continuing to rise, and one of the best performing assets year to date. Maybe in the case of where all else is volatile, gold is solid. And we will deal with the climate politics discussion next week. So that has been a very short, abbreviated Markets Happy Hour. I will come back to discuss the uncertainty point in a separate short podcast posted to this platform. And we'll see you for our normal length podcast next week. Thank you for watching, everybody.